Iron Financial. This is where we forge stronger portfolios by putting market headlines under the stress test. And today, man, have we got one for you. We are putting VICI Properties, that's ticker VICI, right on the anvil. Now, they just dropped their earnings, and honestly, the news is all over the place. It's this wild mix of incredible strength and some pretty scary weakness. You've got this real estate empire, right? We're talking some of the most iconic properties in the world. But then you look at the stock, and it is just getting hammered, trading near its 52-week lows. So what gives? Our job today is to cut right through all that noise, to analyze the actual structural integrity of this company. We're going to find out if this thing is a fortress built to last or just a pretty facade that's about to crumble. Okay, so let's get right into it. You gotta listen to the language coming straight from the top. The CEO, Edward Pinetiak, he's painting this picture, right? He wants you to see him as this master blacksmith, forging alliances, building out an empire, reinforcing VICI's spot as the undisputed king of what they call experiential real estate. The message is crystal clear. They believe they're building something permanent, something totally unshakable, something built on the bedrock of these strategic relationships. It's all about strength. It's all about durability. That's the story they're selling. Okay, that all sounds fantastic, right? But you know what? Talk is cheap. While the CEO is up there talking about some enduring strategic ethos, the market is telling a totally different story. The stock is just stuck, hovering near its 52-week low, and the headlines, they're flashing some serious warning signs. You've got analyst downgrades popping up, you've got major concerns being raised about their biggest tenants. It's just a storm of negativity. So the question we have to ask is a simple one. Is this fortress really as strong as they say it is, or is the market seeing some cracks in the foundation that all these fancy words from the CEO are just trying to paper over? Let's dig in and find out. All right, before we start looking for those cracks, let's take a step back. You have to respect the structure that they've actually built here. To really get VICI, you have to wrap your head around the sheer scale and, more importantly, the quality of what they own. Look, this is not some random collection of sad little strip malls or empty office buildings. No way. This is a portfolio of absolutely iconic, cash-gushing landmarks. We're talking about properties that are, let's be honest, pretty much irreplaceable pillars of the whole American experience. So take a look at this. The quality here is just off the charts. We are talking about the bedrock of the Las Vegas Strip, and so much more. You've got Caesar's Palace, the MGM Grand, the Venetian. I mean, come on. These are not just buildings, they're cultural icons. The whole portfolio spans 93 different properties. And get this, a staggering 127 million square feet. But here's the real secret sauce. The most important detail isn't just the names on the buildings, it's the structure of the deals themselves. They're all long-term triple net leases. Now, what does that mean? It's simple. The tenants, the casino operators, they are responsible for everything. All the taxes, the insurance, the maintenance, you name it. VICI's job? It's basically just to be the landlord and collect the rent check. It's a business model designed from the ground up to be a fortress of predictable, inflation-resistant cash flow. It's beautiful. Right, but a fortress is only as strong as its last battle, isn't it? And I've got to tell you, in this last quarter, in their most recent earnings report, VICI took some serious cannon fire directly to the main gate. The headlines were not kind at all. And the market? It responded exactly how you'd expect, with pure fear. See, when those numbers come out, there's absolutely nowhere to hide. And the reaction from investors was, well, it was brutal. So the first arrow fired? It was a clean shot, a straight-up earnings miss. I mean, this is the number one thing Wall Street is looking for every single quarter. And boom, they didn't deliver. That immediately puts the whole company on the defensive. Now they have to start explaining what went wrong. And right after that came another volley. The revenue, it also fell short of what everyone was expecting. So now you've got a miss on both the top and the bottom line. That's the classic 1-2 punch that makes investors start to get really nervous and question the whole growth story. You start wondering, right? Is the engine that powers this massive empire, is it starting to sputter? And I want to be super clear here. This was not a small miss. They didn't just barely miss. They missed the consensus earnings per share estimate by over 9%. 9. That is not a rounding error, folks. That is a huge deviation from what all the smartest analysts on Wall Street were predicting. A miss that big, it does two things. It triggers all the automated selling from the quant funds, and it forces actual human portfolio managers to sit down and reevaluate their entire thesis on the company's ability to earn money. It is, without a doubt, a very big deal. Okay. The numbers don't lie. He's absolutely right. The data you're seeing here is crystal clear. Q4 was a miss. The consensus was looking for 66 cents per share in what's called adjusted funds from operations, or AFFO, and VICI delivered only 60 cents. Now, for a REIT like VICI, AFFO is the only metric that really matters. You can forget about traditional net income. That gets all messed up by non-cash stuff like depreciation. AFFO gives you that clean picture of the actual cash flow that's available to be paid out to shareholders like you and me. It's the lifeblood of the company. And on that metric, yes, they missed. But, and this is a big but, this is where we need to be analysts, not just headline readers. A single quarterly report, that's just one battle. It's not the entire war. To understand the real strength of this fortress, we have to go deeper. We need to inspect the foundation itself. All right, let's do it. Let's drill down past those scary headlines and get our hands dirty. When you're analyzing a structure this big, you can't just look at the paint job. You have to look at the core materials it's built from. And for a real estate investment trust, a REIT like VICI, that means we have to look past 1 weak quarter and really examine the core profitability, the full-year cash flow, because this is where the real story is, and it's a story that those quarterly headlines completely, totally ignored. Okay, get ready. This right here, this is the number that matters. I want you to forget the quarterly miss just for 1 second and focus on this, 92.6%. What is that? That is VICI's operating margin. This single number is the financial bedrock of the entire company. It is the absolute core of the bull case, and let me tell you, it is completely elite. I mean, an operating margin this high it's almost unheard of. To put this in perspective for you, a super profitable software company, one of those tech darlings, might dream of a 40% margin. VICI is at 92.6%. Think about what that means. For every single dollar in rent that comes in the door, over 92 cents of it drops straight down to operating profit. That's an incredibly efficient, lean business model that just converts revenue directly into profit with almost zero friction. This is the kind of structural integrity we look for at Iron Financial. It tells you that the basic business, just owning these amazing properties and collecting rent, is fundamentally sound and, frankly, immensely profitable.
Okay, a strong margin is good. I get it. But a strong margin on shrinking revenue is a big problem. You can't just ignore that Q4 revenue miss. What good is all that efficiency if the top line is stalling out? Fair point. But you have to look at the full picture. Let's zoom out from that 1 quarter and look at the full year to see how this story builds. For the entire 12 months of 2025, revenue grew from $3.8 billion to $4.0 billion. That's a 4.1% increase year over year. So yeah, 1 quarter was a little light, but the heavy lifting for the full year, it still got done. The empire is still expanding its borders. It is not shrinking.
And this right here, this illustrates the real story perfectly. That adjusted funds from operations, again, that's the critical cash flow metric we talked about. It grew by a powerful 6.6% for the full year. It accelerated from $2.4 billion to $2.5 billion. So here's the crucial point, right? While all the headlines were screaming about 1 quarterly miss, the core economic engine of this company was actually picking up speed for the full year. That is a massive disconnect between the market's fearful story and the actual underlying financial reality of this business. All right, you know what? The foundation seems solid. I'll give you that. Those full-year numbers are definitely strong, but a fortress under siege can't just sit there and count on its thick walls, right? So what are they actually doing to reinforce those walls, to expand their territory? Are they just hunkered down, defending what they've got? Or are they pushing back and going on the attack? That is exactly the right question to be asking. And the answer? Oh, they are not just defending. They are on the offensive, forging those new alliances just like their CEO promised. Get this, in 2025, VICI committed over $2.1 billion in new capital to expand its empire. Now, that is an aggressive push for growth, especially in this higher interest rate environment we're in. And more importantly, look at how they did it. They put that money to work at a very attractive weighted average initial yield of 8.9%. Let me just say that again, 8.9%. In a world where you're lucky to get, 5% on a safe government bond, locking in yields approaching 9% on world-class irreplaceable assets, that's a masterstroke. They are building new walls, and they're building them very, very profitably. And check it out. They're not just buying more of the same old thing. No, they're strategically diversifying their partnerships. They're bringing new, high-quality operators into the fold. So you've got them investing in a luxury development in Beverly Hills with Kane and Eldridge. You've got them funding new casino construction with Red Rock Resorts. You've got them executing a massive sale-leaseback deal with Golden Entertainment. You see the pattern? Each one of these deals isn't just about patching a hole. It's about building a whole new bastion of growth. And this is critical, diversifying their rent checks away from their biggest partners. Okay, these big multi-step deals, they can get pretty complex. Let's break one down. How does a massive transaction like that Golden Entertainment deal actually make the whole fortress stronger? It's a textbook move. It's what a world-class landlord does. Honestly, it's a beautiful piece of financial engineering. So, step one, they take over $1 billion and buy the hard assets, the land, the buildings, for 7 different casinos, including the iconic STR8 in Las Vegas. Got it? Step two, they immediately turn around and lock in a new tenant with a 30-year triple net master lease. 30 years. That is 3 decades of locked-in cash flow. Step three, that lease immediately starts spitting out $87 million a year in rent, and it has built-in escalators to fight off inflation. And step four, and listen up because this is the most important part from a risk perspective, it adds a 15th tenant to their roster. Every single deal they do like this is another strategic reinforcement. It makes the entire structure less and less dependent on any single part of that wall. Okay, I'm with you. The foundation is strong. They're actively building reinforcements, I see it. But every fortress, no matter how strong it looks, has a potential weakness, right? An Achilles heel. And for VCI, the biggest one is just impossible to ignore. It's a concentration risk so large that it has multiple Wall Street firms ringing the alarm bells. This is the heart of the bear case against the stock. And here it is. This is the central issue. This chart right here says it all. 74%. Let that sink in. Nearly 3/4 of their entire rental income comes from just 2 tenants, Caesars and MGM. Now sure, they're adding new partners and that's great, but the reality today is that the fate of VICI is overwhelmingly tied to the financial health of these 2 gaming giants. And analysts are getting specific. They're flagging the Caesars regional master lease, which all by itself accounts for about 1/4 of VICI's total income. One lease? That is not a small crack in the armor, my friends. That is a massive, wide-open, unguarded gate. If Caesars stumbles for any reason, a decade of bad management, a big shift in how people gamble, VICI feels that pain in a huge way. Okay, but let's put that risk in context for a second. The biggest institutions on the planet, I'm talking BlackRock, Vanguard, State Street, they own nearly 100% of this company. These guys employ armies of analysts who have absolutely stress-tested that concentration risk, and they still have confidence in the structure. But hold on. What about the people who are supposed to know the company best, the insiders, the executives in the C-suite? They own less than 1/3 of 1% of the entire company. That's not just low, that's a rounding error. When a management team has so little of their own money tied up in the stock, it raises huge questions about whether they're really aligned with shareholders like us. Where's their skin in the game? I mean, if they truly believe the stock is a screaming bargain down here, wouldn't you expect to see them buying it up? The fact that they aren't, well, that silence speaks volumes. And then there's this, which just adds another layer of concern for me. It's called the Altman Z-score. It's this old, well-respected formula that tries to measure bankruptcy risk. And it puts VIC smack dab in the gray area with a score of 2. Now, let's be clear. This doesn't mean they're going bankrupt tomorrow. A score above 3 is considered safe. Below 1.8 is the real danger zone. So VCI is right there in the middle. But you know what it is? It's like a yellow warning light on the dashboard of your car. It suggests there might be some financial stress hiding under the surface that really needs a closer look, especially when you pile it on top of that massive tenant concentration problem. It tells me that the margin for error here might be a whole lot thinner than that big, flashy 92% operating margin makes it seem. All right, so we've inspected the fortress, we've tallied up the damage from that Q4 headline attack, and we've probed the walls for weaknesses. It all comes down to this. What's the final verdict for your portfolio? Is this a world-class asset that's just on sale? Or is this a trap waiting to be sprung? Look, the bull case, the argument for the fortress, it's clear and it's compelling. You've got that rock-solid, almost unbelievable 92.6% operating margin. You've got consistent, powerful, full-year cash flow growth even with that weak Q4. You've got a management team that's proactively spending billions to diversify. And best of all, because of all this recent fear, the stock is trading at a valuation, a price to FFO multiple that's near its 5-year low. The argument is simple. You're buying elite assets at a deep discount. But the bear case, the argument that there are cracks in this thing is just as clear. That Q4 miss, it could be the canary in the coal mine, the first sign of a real negative trend. That 74% tenant concentration is a systemic risk you just can't ignore. You're making a huge concentrated bet that just 2 companies are going to pay the bills year after year. The analyst downgrades are real. And that combination of extremely low insider ownership and that gray zone Z-score, it should make any smart investor take a long pause. Ultimately, this whole thing comes down to how you assess that one central risk. The numbers, they show a powerful, highly profitable structure that's taking some temporary fire because of one bad quarter, and that's created what could be a really compelling valuation for a long-term investor. But those risks, they feel structural, not temporary. That concentration isn't just going to disappear overnight, so here's the deal. At Iron Financial, we don't give you the answers. What we do is give you the unvarnished data and the unconflicted analysis. We put the steel on the anvil, and we let you see what holds up under pressure. The final call? Well, that's yours to forge.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.